Hey, welcome back. Let me hit you with a number. $10 trillion. That's how much household wealth disappeared in the United States. In just a few weeks, millions of people lost their jobs, their homes, their savings. Not because they did anything wrong, but because a small group of people on Wall Street made a bet. And that bet destroyed the global economy. And here's what nobody wants to talk about. Everything that caused the 2008 crash is happening right now. Stay with me. By the end of this video, and you'll know exactly what happened, who caused it, and how to protect yourself when it hits again. To understand the crash, we need to go back to the early 2000s. America had a dream. Everyone should own a home. The government loved it. Banks loved it. And honestly, for a while it worked. But then something changed. Banks realized they could make enormous profits by giving mortgages to people who couldn't actually afford them. These were called subprime mortgages. Loans given to people with bad credit, low income, and almost zero savings. Normally, a bank wouldn't do this. But the banks found a workaround, a very creative one. They started packaging thousands of these risky mortgages together and selling them as investment products called CDOs, collateralized debt obligations. They sold these packages to investors worldwide who had no idea what was actually inside. And rating agencies gave these toxic products the highest possible safety rating. Why? Because the banks were paying the rating agencies to rate them. A conflict of interest, hiding in plain sight. Here's exactly how the machine worked, step by step. Step 1. A mortgage broker convinces a family with bad credit to take a $400,000 loan on a house they can't afford. The broker gets a commission and doesn't care if the loan ever gets repaid. Step 2. The bank buys this mortgage, bundles it with thousands of others, and creates a CDO. Step 3. They sell that CDO to investors worldwide. The bank gets cash immediately and transfers all the risk to someone else. Step 4. With fresh cash, the bank gives out more subprime mortgages, and the whole cycle repeats. Now here's where it gets really dangerous. A new product appeared. Credit default swaps. Think of it as insurance on the toxic CDOs. Hedge funds were literally betting that the CDOs would fail, and companies like AIG were selling this insurance in massive amounts, without keeping enough money to pay if things went wrong. By 2006, the US housing market was the biggest financial bubble in history. Home prices had risen 124% in just 10 years. Everyone assumed prices would keep rising forever. They were wrong. In 2006, interest rates started rising. Suddenly, millions of borrowers couldn't afford their payments. Foreclosures exploded across America. Home prices started falling, and as prices fell, those safe CDOs became worthless overnight. March 2008. Bear Stearns, one of Wall Street's biggest banks, collapsed overnight. September 15th, 2008. Lehman Brothers, a 158-year-old bank, filed for the largest bankruptcy in American history. The stock market lost 777 points in a single day. Within weeks, global credit markets froze. Banks stopped lending to each other. Businesses couldn't pay employees. 8 million people lost their jobs. 6 million lost their homes. The crisis hit Europe, Asia, Latin America. The U.S. government responded with a $700 billion bailout, taxpayer money, to save the very banks that caused the crisis. The bankers kept their bonuses. Almost no one went to jail. Let's be clear about who caused this. The banks created and sold products they knew were toxic. Goldman Sachs was literally betting against the same CDOs they were selling to their own clients. The rating agencies gave fraudulent ratings for profit. The regulators had the power to stop this, did nothing. The Federal Reserve, why? Kept interest rates too low for too long. The government actively encouraged banks to give mortgages to people who couldn't afford them. Regular people lost everything. Wall Street got a bailout. The system was broken, and it was never truly fixed. So here's what should actually worry you right now in 2026. Number 1. The U.S. national debt has crossed $36 trillion. Advanced economies are at debt levels not seen since World War II. Number 2. Private credit funds now manage over $2 trillion and with little regulation and high leverage. Sound familiar? Number 3. AI stock valuations are approaching dot-com bubble levels. One bad earnings report could trigger a massive sell-off. Number 4. Commercial real estate is in crisis. Office buildings worth a fraction of their 2019 value. Banks holding those loans are under pressure. Number 5. Trade wars, geopolitical conflicts, a fragmenting global financial system. One major shock could cascade into something far bigger. The specific trigger will be different from 2008. But the underlying conditions, debt, leverage, greed, weak regulation, are exactly the same. 1. Diversify aggressively. Stocks, bonds, real estate, gold, a small crypto allocation. Don't put everything in one basket. 2. Hold some gold or commodities. In every financial crisis in history, gold has held its value. 3. Eliminate high-interest debt now. Credit card debt above 15%? Paying that off is your best investment. 4. Build a 6-month emergency fund. When credit markets freeze, liquid cash is survival. 5. I'd invest in index funds, not speculation. The S&P 500 has survived every crash in history. Slow, boring, consistent. It wins every time. 6. Don't panic. The people who sell in a crash lock in their losses. The people who stay calm come out ahead. The 2008 financial crisis wasn't an accident. It was the predictable result of unchecked greed, weak regulation, and a system that privatizes profits and socializes losses. And until those problems are truly fixed, and they haven't been, the conditions for another crisis will always exist. And until those problems are truly fixed,
as expected.
And they
There's
haven't
no need
been,
to worry.
the conditions for another crisis will always exist. If this helped you, hit subscribe. Every week we break down the biggest money stories in the world. No hype, no noise, just facts.